Section 1033 is the involuntary conversion rule. Think casualty, theft, or condemnation. You didn't choose to sell, but you got money for the property. Gain happens when the reimbursement or award is more than your adjusted basis. The key exam move. Section 1033 can let you defer that gain if you buy qualifying replacement property within the replacement period. Here's what Section 1033 is not. It's not a Section 1031 exchange. There's no 45-day identification rule, number 180-day closing rule, and no qualified intermediary requirement. On the EA exam, they love slipping in QI language to bait you into 1031 thinking. For 1033, you can receive the check directly and still defer gain if you properly replace. Replacement periods are the timing heart of Section 1033. The general rule ends 2 years after the end of the first tax year you realize any gain. Then there are special longer periods. Real property used in a business or held for investment, like rentals, gets 3 years. Livestock sold due to weather gets 4 years. And a main home in a federally declared disaster area can get 4, sometimes 5 years. Now the mechanics. If you replace with similar or related in service or use property, you can elect to defer gain to the extent you reinvest the proceeds. If you reinvest all the proceeds, recognized gain is usually 0. If you reinvest only part, you recognize gain up to the amount not reinvested. That "to the extent not reinvested" phrase is a classic exam trigger. Basis after replacement is where points are hiding. The clean way to remember it: replacement basis equals cost minus deferred gain. Another equivalent way: start with old adjusted basis, then add any extra money you paid, and add any gain you were forced to recognize. If you deferred all the gain and paid extra out of pocket, your basis goes up only by that extra amount and certain acquisition costs. Condemnation is just an involuntary conversion with a legal flavor: eminent domain, forced sale, or even threat of condemnation. For timing, condemnations of business or investment real estate generally fall into that 3-year replacement period bucket. If the taxpayer doesn't replace, the award is taxable gain to the extent it exceeds adjusted basis, just like any other disposition. Main home condemnations and disasters add a twist. Coordinate Section 121 with Section 1033. If the home qualifies, you apply the Section 121 exclusion first, up to $250,000 single or $500,000 joint. Then, only any remaining gain can potentially be deferred under Section 1033 if the taxpayer reinvests in a replacement home. On the EA exam, the ordering matters. Exclude under 121, then defer under 1033. Raphael owns a van used only in his airport shuttle business. It's totaled. His adjusted basis is $28,000. Insurance pays him $45,000. A week later, he buys a replacement shuttle van and pays $4,000 out of pocket on top of the insurance money. What's his basis in the new van, and how much is taxable? Think about it. The answer is $32,000 basis and 0 taxable gain. He reinvested all the insurance proceeds in qualifying replacement business property, so Section 1033 lets him defer the entire gain. Basis becomes the old adjusted basis, $28,000 plus the extra $4,000 he paid. The tempting wrong choice is the one that taxes the $21,000 gain, but that ignores the Section 1033 election and full reinvestment. Marisol owns a duplex. She lives in one unit and rents the other. The government condemns the property and pays her $90,000. Her original cost was $75,000 plus $15,000 of improvements split equally. She took $20,000 of depreciation on the rental half, and she paid $2,000 of legal fees for the settlement. She doesn't replace the property. What taxable gain or loss does she report? Think about it. Correct answer: taxable gain of $19,000. Treat it as 2 properties: personal half and rental half. Split the award and legal fees. Each half has $45,000 proceeds minus $1,000 fees, so $44,000 net. Each half's cost basis is $45,000, but the rental half is reduced by $20,000 depreciation to $25,000, creating $19,000 gain. The personal half has a 1,000 loss, but personal use losses aren't deductible. Very testable.